Have you ever wondered why some IPOs get oversubscribed within hours while others struggle to find investors? What makes certain companies so attractive to investors and what factors drive this frenzy? In this video, we'll explore the key reasons behind IPO oversubscription and help you understand what makes an IPO a success. Let's start by understanding what IPO oversubscription means. When a company launches an IPO, it offers a fixed number of shares to the public. If the demand for these shares exceeds the supply, the IPO is considered oversubscribed. The higher the oversubscription, the more investor interest it reflects. This often leads to a price surge on the listing day, offering potential short-term gains. Several factors influence whether an IPO gets oversubscribed. Let's dive into the most important ones. 1. Company reputation and brand value. Investors trust well-established companies with strong financial records. Brands like TCS, LIC, and Nika generated massive investor interest due to their credibility. 2. Market conditions. A bullish market makes investors more optimistic, leading to higher IPO demand. In contrast, a bearish market reduces enthusiasm, lowering subscriptions. 3. IPO pricing strategy. If an IPO is priced too high, investors may hesitate, but if it's reasonably priced, it attracts more buyers, leading to oversubscription. 4. Financial performance and growth potential companies. With steady revenue, profitability, and strong growth prospects get more attention. Tech startups like Zomato and Nika attracted investors despite initial losses, thanks to their growth potential. 5. Institutional and promoter confidence. When promoters and institutional investors retain a significant stake, it signals confidence in the company's future, attracting retail investors. 6. Sector popularity and economic trends. Sectors like technology, healthcare, and renewable energy attract more investor interest. Economic trends also play a key role. During COVID-19, healthcare IPOs saw high demand. 7. Marketing and promotion. Effective marketing creates hype. Companies use social media, advertisements, and financial news to build excitement around an IPO. Oversubscription means not all investors get shares. In such cases, allocation happens through a lottery system. High demand can also lead to a listing day premium, where share prices jump on debut. Let's look at some highly oversubscribed IPOs in India. Zomato IPO, oversubscribed 38.25 times Nika IPO, oversubscribed 82 times, and LIC IPO. Despite modest oversubscription, LIC's brand value attracted retail investors. Finally, several factors influence IPO oversubscription: company reputation, market trends, pricing, financials, and investor confidence. However, oversubscription does not guarantee returns. Always research a company's draft red herring prospectus (DRHP), available on SEBI's website before investing. That's it. If you found this video helpful, don't forget to like, share, and subscribe for more insights on the stock market and IPOs. Thanks for watching, and happy investing.